of Precious Metals Research, Tom Kendall. Tom, glad to have you on.
Hi, it's a pleasure.
All right, look, I know Peter's going to be dying to get in here, but I want to start it off because in your note that you say that the gold rally has been a byproduct of some of the fear that we've seen in the Eurozone collapse, and that fear is in the past. But if you look at the European stock market today, if you look at the euro today, that fear very much in the present. So why are investors selling gold?
Yeah, well, gold has had a very good run, as Peter said, and we've come out of this period over the last 3 or 4 years where people have felt really concerned about equities, about housing, about governments, about currencies, and now we're not saying everything in the garden is rosy, but it's looking sufficiently better to investors than it did 12 months ago or 18 months ago for them to start considering putting less of their capital into defensive assets like gold and treasuries and putting more of it to work into something that gives them a yield. And that's what we've been seeing so far this year.
Yeah, well, if you think about it, though, gold doesn't need a political crisis to shine. As a matter of fact, if you go back to 2000 to 2008, before the Eurozone crisis, before the 2008 financial crisis, gold did better in that environment. Stocks were going up, but gold was going up even faster. So why do you think you need to have a political crisis? It's a monetary crisis. There's too much inflation. There's too much money printing. That's what's been driving the gold rally, not the Eurozone.
I'm sorry, the inflation point I don't get because there is no inflation in the developed world. What the central banks are trying to do is to do everything in their power to avoid deflation. There is no inflation pressure either
There's
in
plenty of inflation. The government doesn't want to acknowledge it,
right
but
now.
Prices are rising. Consumer prices are going up. Money supplies are expanding. That's the definition of inflation. You can see the inflation in the bond markets. You have bond bubbles. You have housing bubbles. Look what's going on in the world. Interest rates are too low. There's too much money creation. That's inflation. That has to stop. But the central banks are afraid to let it stop because they don't want to allow the economies to restructure.
Well, I think there's not enough people who any longer agree with that view. That's the problem for the gold market right now. You've seen a very bearish reaction in the gold market over the last week or so, and just the minutes from yesterday from the FOMC meeting in January where you had minutes outlining the fact that FOMC members are discussing the potential for scaling back QE sometime down the line. Just that potential discussion has taken.
They've been discussing that for years. It's all a bluff. It's all bark and no bite. I mean, they've checked into the Roach Motel of monetary policy. They can never withdraw the stimulus. It's all a bluff.
You're saying the stimulus can never be withdrawn, and we're on this QE track indefinitely, way into the future.
Well, not indefinitely. It's going to end when there's a crisis, when there's a currency crisis, when the dollar implodes, when we have a sovereign debt crisis. That's what's going to bring the party to an end. But the Federal Reserve is never going to act preemptively to take away that punch bowl. They're afraid to do that. So they're going to push the envelope as far as they can.
Peter, when does that happen?
I don't know the exact date, but I think every day we get closer to it.
But do you think that that's something that could happen this year, next year, more in the short term, or are we talking about continuing this policy?
It could happen tomorrow. You know, I don't know. I mean, we're living literally on borrowed time. I think we've already gone on longer than it should have, but eventually it's going to come to an end. And you can see, you know, all the problems around the world that are resulting from this monetary policy. And eventually it's going to culminate in a dollar crisis. But until then, it's going to be business as usual at the Fed. But they can't let on that the only thing standing between us and implosion is their quantitative easings. They want people to think that we have a viable economy. So they discuss the possibility of removing the training wheels, even though they know they can't remove them because QE isn't the training wheels. They're the only wheels. If you take the wheels off, the bike's going to fall over.
Tom, your response to that?
Well, I don't know. I'm not quite sure which currency the dollar is going to implode against. It certainly doesn't look like it's imploding against the yen or the euro. You know, at some point in the future, down the track, the unintended consequences of today's monetary policy may indeed come back to hurt investors through inflation, through some kind of currency crisis, through some kind of other debt crisis. But I think the issue is that in the interim, and I think that potential crisis, if it happens, is a considerable way down the track. In the interim, things are looking better. You know, the U.S. housing market is picking up. It's picking up from a very low point for sure, but it's picking up. equity markets have done reasonably
I
well
think
so
that
far
that's
this
actually
year.
part
They're
of the
pausing now,
problem.
but it's looking better. And, you know, when things are looking better, gold goes down.
Peter, why is that part of the problem?
Because housing prices are still too high. We're still diverting too many resources to propping up the housing market. We should be building factories, not houses. The government is trying to reflate that bubble. This is just, you know, digging us into a deeper hole. But the recovery is an illusion. It's all built on a mountain of debt, and it's papered over by inflation. And when you talk about the dollar imploding, all currencies can go down simultaneously. It implodes relative to its absolute purchasing power. You need more dollars to buy oil. You need more dollars to buy food. But eventually, I think the dollar is going to lose a lot of value against other fiat currencies. You've got other currencies intervening now. They're trying to weaken their currency against the dollar. They're trying to prop the dollar up. Look at what's happening in New Zealand. Look what's happening in Norway. Look what's happening in Switzerland. And, of course, the yen wouldn't be weakening if the Japanese weren't talking it down. I mean, everybody is trying to weaken their currency to prop up the dollar. But eventually they're going to give up this foolish policy because the more money the world loans us, the deeper the problems get. They can't vendor finance us forever. Eventually they're going to have to stop doing it. And then the dollar is going to lose value even against, you know, other fiat currencies, even as all fiat currencies will lose value against gold based on this current race to the base.
Tom, your take on Peter's comments.
Well, look, you know, as I said at the start, we're not saying everything in the garden is rosy, and the U.S. undoubtedly has some serious structural issues to address in terms of tax, of spending, and there doesn't seem to be an easy way through that. But, you know, the economy is, for all of that, improving. You see that in factory output, you see that in hiring, you see that in business investment, and in that environment, whether Peter likes it or not, the number of large-scale investors like George Soros who feel they need to have a significant proportion of their money in tail-risk hedge assets like gold is diminishing.
All right, Tom, before I let you go, if gold is overvalued, as you say, then how far can it go? What's your price target for the end of the year?
Well, we don't specifically publish targets in that way, but when you're talking about where gold can go to in that kind of space of time, I think you have to remember that it was only 2 years ago that gold was trading at $1,400, and it was only at 5 years ago that it was at $650 an ounce. So, you know, if we do see by the middle of this year the Fed scaling back its QE, as has been discussed, then I think you've got to consider where gold goes back to relative to what's been happening over the market over the last 3 or 4 years.
Okay, our thanks to Tom Kendall of Credit Suisse.